Welcome to the Advisory Group's Introduction to Modern Investment Concepts for 2022. Thank you for viewing this webinar. Let's first do some introductions. My name is Chris Lee, and I am the Vice President of the Advisory Group. My business partner, Brent Beverly, the President of the Advisory Group, and Manny Chinche, one of our long-time experienced advisors, will be speaking. The three of us are certified financial planner practitioners. Also presenting with us today is William Glenn, another member of our tag team. While we are the lead advisors for the advisory group, our tag team is what makes the advisory group shine. If you have not yet met the rest of our tag team members, please be sure to visit our office. Before we begin, it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try always to consider the impact of any recommendation we make on not just one, but all of these areas for our clients. Today's presentation will be primarily focused on investment planning. Of course, there are important disclosures that need to be made. This discussion is intended to be educational. None of this is intended as a solicitation or recommendation of these investments. You need to be guided by your financial advisor and your other advisors, such as your attorney and tax advisor, before trying to implement any of these concepts. Any investment has certain advantages and disadvantages. Most investment portfolios should combine different investment vehicles to achieve a balanced approach to achieving your long-term goals. In case you haven't heard, it's a new world out there. There have been some new investment concepts and investment tools that have been introduced over the last few years, and we want to make sure that you have an awareness on how they can be used. Today we will be covering several new areas of investing that can be integrated into your diversified portfolio. These concepts do not replace the time-tested investment concepts, but can add to them and complement them. Today we will be reviewing 3 of these new tools. We'll begin with indexed annuities. Then we will talk about buffered exchange-traded funds, which incorporate structured products. And finally, we'll talk about digital currencies. To start us off with the indexed annuities, here is Mr. Beverly.
Thank you, Chris. Let me launch into some definitions for you here. There are 2 basic kinds of index annuities out there. The first one is called a fixed index annuity. These investments typically follow an index with a low cap and 0 downside risk. Now, we're going to explain what those terms mean here shortly. The second one, where we're going to spend most of our time today, is on the more complex and potentially more profitable over the long term RILA, or Registered Index Linked Annuity. Easy for me to say. That's why we use RILA. All right, Registered Index Linked Annuity. This kind of annuity goes by a variety of names, such as buffered annuity, structured annuity, index variable annuity. As you can tell from the names, there are just a lot of variations on these investments. There are, of course, some additional disclosures that need to apply to annuities. So for fixed annuities, we need to let you know that, please read this at your leisure so that you have a chance to actually follow through and read through this. So I'm going to leave it up here for just a couple of minutes. Since this is a recorded copy, I won't read the whole thing. The registered index linked annuities, the RILAs, also have their disclosures that you need to be aware of. Probably most key here is make sure you read the prospectus. We talk about these things. You're going to hear this a lot today. When you've read one of these annuities, you've read one of these annuities. Each one's a little bit different. As we dig into these annuities, one of the things we want you to be aware of is how taxes work when dealing with annuities. And these are annuities in general, but these specifically. All income within an annuity is completely tax deferred so long as it stays within an annuity. So if you decide to change annuities later on, you can do what was called a 1035 tax deferred exchange to another annuity and continue to defer your taxes. It's a very nice benefit. When you pull funds out of an annuity, though, your distribution comes out as taxable income first. The income portion comes out as ordinary income, another term you should know, even if it was in there for a long-term investment. Now, in a non-annuity investment, you might expect to generate long-term capital gains, which are taxed at a lower rate typically. But with annuities, all gains may be deferred, but they're considered ordinary income when you distribute them out of the annuity. Now, all the taxable portion comes out first unless you're annuitizing. If you have a non-qualified annuity where you put in some after-tax funds, you don't have to pay tax on those investment funds again, but they only come out after all of the taxable funds have come out and any taxable gains have had the taxes paid on them. Now, of course, if you have an IRA or some other pension plan where all the funds in the annuity are before tax money, well, your distributions would be completely taxable regardless. In that case, you can do a trustee-to-trustee transfer of your IRA to another IRA, including a non-annuity vehicle, without paying taxes on the transfer. I also want to remind everyone that IRAs, just like IRAs and pension plans, even non-qualified annuities have additional tax penalties if you pull funds out before age 59 and a half. This rule is designed to encourage long-term investment, which is why you have these rules. And in fact, when they designed the rules for IRAs, they went over to the annuity rules and used those to define age 59 and a half and that kind of stuff. Let's continue with the terminology. Now, your investment may go up or down in these annuities. It may lose money, so you need to know how it works. There are a lot of moving parts on these annuities. Index annuities are complex and are not for those who are not educated in the ramifications of these terms that we're going to go over now. To help you understand these complex investments, we're covering many of the important terms here. Please realize there are other components to these policies that need to be considered before investing. Every policy is different. So you heard me refer to it before, but we joke that, quote, when you've read one annuity contract, you've read only one annuity contract. You cannot assume that just because you understand one contract, that you understand all of the contracts, even within a single company. So today we'll be briefly covering some of the indexes that are used, how buffers and floors can provide an element of protection for your investments, how index caps work and how they might affect your results, what to look for in what are called segment term limits, how the participation rate may affect your results, and finally, what to look for regarding fees and costs on your policies. What makes these investments different is that the returns are based on the returns of an independent index. Most common of these are the S&P 500, which is often used as a broad measure of the U.S. stock market. You might see the MSCI EAFE, or as it's spelled out, the Morgan Stanley Capital International Europe, Australasia, and Far East Index. I'll stick with MSCI EAFE, but that's okay. So this index pretty much covers the developed world outside the USA. Now, oftentimes we'll see the Russell 2000 index, considered a measure of the small cap companies for the USA. And most RILA companies also work with other market indexes, and a lot of companies are using indexes based on their own combinations of indexes or managed accounts. There are just too many to even try to list them here. Using these index provides an important point on these annuities. You're not actually investing in the stock markets or in any of these indexes. What the company does is it purchases options, typically uses put and call options, and based on these indexes to give you an investment boundaries where we're going to discuss in a few minutes. The annuity companies are not taking a risk here on your investments. They're not actually buying stocks or mutual funds. They will sell the call options and use those funds to buy put options that transfer all of the risk to these other holders. The company then typically puts away most of your funds into fixed income investments to earn interest, which they keep during your holding period. An important note is that the calculation of the index value does not include dividends being reinvested. Now, if you were to invest in a mutual fund that invests in companies that comprise one of these indexes, typically you'll receive and often reinvest the dividends those companies pay out, potentially increasing your total return. Now, as an example, if you were to invest in a mutual fund that emulates the S&P 500, you would expect to see dividends from the underlying stocks being paid out and likely being reinvested into that fund on a regular basis. With the S&P 500 index used for these structured investments, dividends are not considered in determining the value of the index, and that could make a difference in your results. The big attraction of these investments is that they provide some protection from loss. Now notice the key word in that sentence, some protection against loss. Now remember a few slides ago we spoke of the fixed index annuities or FIAs. Now these investments typically have zero downside, so they're 100% protected on the downside, but they typically don't make as much money on the upside. When we discuss the RILAs, the registered index-linked annuities, you'll see less protection, but you will also likely to see more potential long-term returns. The protection usually comes in one of two forms. It may come in the form of a buffer, or it may come as a floor. So let's look at how these might work. If your index investment has a positive return at the end of your investment period, your return is positive, and the protections don't do anything. However, if your index is down at the end of your investment return, this is when the protection may help. So if you have a buffer, so let's look at a buffer here. If you have a buffer, the buffer protects you for that first portion of the downward results down to the level of your buffer. So buffers are typically at 5% or 10% or 20%. We've also seen buffers at 15 and 30%. You pick your buffer when you start your investment term, and it does not change until the end of that period of time. So let's use the example of a 5% buffer. So if your investment is down 5% or less, let's say it's down 4%. Wow, our buffer's at 5, we're down 4. You have no loss. You will retain your original investment amount. They will bring you back to what you started with. If your investment is down, let's say 10%, then the 5% buffer protects the first 5% of your investment, but you'll lose the remaining percentage. In this case, down 10% minus the 5% buffer means your investment would be down 5%. If your investment in that example dropped by 20%, then you would be down 15%. 20% minus the 5% buffer, you take the rest. See how that works? By using our chart here down to the buffer, your investment is protected. Below the buffer, you take the additional loss. Now let's contrast that with the floor. When we look at the floor over here, you take all the loss down to the floor, but you don't take any of the loss beyond that. So using our example of a 5% floor, in this case, if your investment is down 4%, you're down 4%. But if your investment is down more than 5%, the 5% floor does not protect the first 5% of your investment, but anything below that, it protects everything beyond that. In this case, if your investment index was down that 10% number, or even down 20%, that means you're down 5%. You don't lose any more than that. So, gee, that sounds great. You mean I can invest in the S&P 500 index, and if I guess wrong, I have a buffer of minus 10 or minus 20% protection? Well, just remember, where there's a gimme, there's a gotcha. For index annuities, one of the most common gotchas, if you will, is the cap rate. So what is the cap rate? So think of cap, C-A-P, as being the level above which you cannot go, wearing a cap on your head. On the upside, you will keep all or a portion of the gain of the index that you're using up to the cap rate. So the cap rate is the most you can make on your results at the end of the investment term. So let's use an example. Let's say you're using the S&P 500 index on your annuity and you have a cap rate of 10%. If the index at the end of your investment is up 30%, well, you get to keep 10% of that, i.e. up to your cap. If your index made 8%, you would get to keep 8% because that's below the cap of 10%. Remember when we talked about the fixed index annuities earlier, the FIAs? I noted that these investments come with no chance of downside loss. That FIA typically comes with a pretty low cap on the results, sometimes as low as 2% or so for a one-year term. Now, when using a RILA, or the Registered Index Linked Annuity, the caps are typically higher. As you would expect, the greater the protection you choose, the lower the cap is likely to be. The longer the segment investment term you choose, the higher the cap is likely to be. The different indexes will also use different cap rates. So we've seen cap rates run from single digits to unlimited, depending on your other choices and market conditions. All of these conditions are set at the beginning of each segment investment, each time you go into a new segment. Let's look at those segment term periods that we're talking about. We're looking at the time in which the protection kicks in. So if you have a 5% buffer, as we discussed before, when does that get applied to your results? The answer is at the end of your segment term period. So when we say segment, we may have invested using different indexes with different protection levels coming due at different dates or term period. Each of those would be a different segment. So what terms are available? What time frames do we have? And of course, as with all these, it depends. Yes, we're back to our statement that when you've read one annuity contract, you have read just one annuity contract. Each company may offer different periods. Almost all of them use a one-year segment, but many also have 2 or 3 year periods. Most policies also have a period that lasts until the end of the surrender charge of the contract, typically 5 or 6 years, some as long as 7. As we noted previously, the longer the term before your protection is applied, typically the higher your possible return can be. Now, you may want to pick a term period depending on when you need to take the money out of the annuity. So if you need to take the funds out annually or take a portion of the funds out annually, it may make more sense to have the protection applied just before you withdraw the funds. So it's a good idea to work with your advisor on all this. As one of our clients used to say, but wait, there's more. Within the investments, there are different time frames for computing the returns. Most popular is the point-to-point strategy. When you start the investment, they take a snapshot of the index value. And when you reach the end of your term, they take another snapshot of the index value and compare them. By comparing the values, they determine whether the index change was positive or negative and by how much. They then apply your protection or your cap, depending on which one it is, and let you know what your investment return was. Now, some companies allow a monthly average. Now, we rarely recommend this as your monthly results are often capped, but the downturn returns are unlimited. But that said, in certain markets, this can provide you with a higher result, which is why some investors like to use it. Another feature that some companies offer is what's called a periodic lock or a term bailout. There are different terms that mean it. So let's say, as an example, that you see the market zoom up beyond your wildest expectations and you want to get out of the investment before it drops. Many companies will allow that, but they will have various restrictions on how you can get back in. Okay? Whether you can go back in immediately, whether you can go back at different values, whether you have to wait till the end of what your original term was. We won't go through all those variations here. The rules can be complex, and need I say it again, if you've read one annuity contract, okay, you got it. There's one other term that I want to make sure that you understand here. It's vital to the understanding of these investments, and that's the participation rate. Now, this can be both a huge benefit and a benefit reducer. So again, we think it's really important you understand how this works. The participation rate is how much of the index return you get to keep. Now, sometimes instead of a cap being put on your investment, they may put a participation rate in. So if you have a, say, 60% participation rate and the index goes up 10%, well, you would receive a 6% return, 60% of the 10%. What if the participation rate is more than 100%? What if, as an example, it's 110%? Then your rate of return could actually be greater than the return on the investment index. In this example, if the index were up 10% and your participation rate is 110%, instead of being up 10%, you're going to be up 11%. Now, we're seeing more of these, often 105%, some as high as 125 or even 140% participation rates. Now, note, oftentimes there are other costs or caps that may bring these results down, so make sure you're looking at all the points that apply to this annuity. Now, one of the quirks that we've seen is that different participation rates may be applied at different levels. Now, this gets a little confusing, but for example, a company may use a 100% participation rate up to the first 20% of return, and then apply a higher or lower participation to returns above that level. So, read the fine print. Also, if there's a cap which is also applied to your investment, the cap rate is usually applied after the participation rate is applied. All right, so you may have, as an example, you may have a 10% cap and a 60% participation, and if your investment's up 20%, well, 60%, you would have made 12%, but with your cap at 10, they figure the 12 capped at 10, you get 10. Is your head spinning yet? There are a lot of details to keep in mind when dealing with these investments. They can be worth it though. All right. Whether your goal is additional downside protection or accelerated results using the participation rates above 100% or both, these can be very helpful investment tools. There's one final area that I want to make sure we cover, and that is the fees and the costs. One of the major benefits of these indexed annuities is oftentimes there are no additional costs or fees, no policy fees, no annual fees, no explicit internal reinvestment fees. Now, I know what you're thinking. Brent, you teach me all the time. What about our favorite concept, Tonstoffel? There ain't no such thing as a free lunch. Well, right, there's not. The way the insurance company makes its money is on the transaction that sets up the bounds of the protection. Remember those puts and calls that we talked about earlier. And then they invest your funds into those fixed income investments during your investment period, and they keep the interest that those funds earn, that investment earns during the period. For an investment with this kind of protection and potential acceleration of your investments at no cost, This can truly be a great benefit. It's not always true. There are some RILAs, some registered index-linked annuities, that will charge annual fees. Oftentimes, the company can use these additional charges to allow for wider benefits or better protection than policies without these additional fees. These fees are usually deducted annually regardless of the term of your investment period. They will reduce your results before any protectionism is applied. So let's say you have a minus 20% downside buffer and your index finishes the period down 10%. Now, you would normally expect the buffer to completely remove all those downside results and protect you completely. However, if your annuity is charging you, say, a 1% fee each year, and you've been in that investment for 6 years, before you reach the end of your investment term, you could find yourself down about 6%, even though the buffer was in place. If index acceleration is your goal and you feel the markets are likely to do very well, you may do better with the higher acceleration, even if you pay some fees. There's no one size fits all. That's why they offer so many variations. It's all about what fits you the best. The final fee that you should know about is the contingent deferred sales charge, or the surrender charge, for leaving the contract before maturity. Now, most companies want a 5 to 7 year commitment on your part. They will have, you've heard this before, a substantial penalty for early withdrawal, since we tend to use the longer investments that we have. This usually is not a big deal, but you need to be aware of the commitment. Now, most companies will have some sort of waiver of this surrender charge. They almost always allow up to 10% of your initial contribution to be pulled out each year without being charged the CDSC, though there may be other variations on that. Some policies have other reasons that they allow penalty-free early withdrawals, such as long-term care, hospital confinement, other medical issues, and almost all annuities will waive the surrender charge in the case of the death of the annuitant. So we've covered a lot regarding these annuities. You can probably tell that we get excited about what they can do. I hope this made a lot of sense to you. I hope these definitions helped you to understand these things. Many of these same concepts and terms also fit our next section. So to give us an introduction to buffered exchange traded funds, please let me bring up Mr. Chinche. Manny?
Thank you, Brent. Now we're going to continue our discussion of structured products here in a minute using exchange traded funds. So we do need to review some important disclosures regarding ETFs before we get to that next level. There you see on your screen, exchange traded funds are sold by prospectus. So please consider the investment objectives, risks, charges, and expenses carefully before investing. The prospectus, which contains this and other information about the investment company, may be obtained from the fund company or from us, your financial professional. Be sure to read the prospectus carefully before deciding whether to invest. So let's continue our discussion of structured products, turning our attention to non-annuity ways to use these investments. Now, we will try to keep things simple and build on all of the terminology that Brent has been presenting, because some of it still remains applicable to this next topic. So in a similar fashion, structured products allow investors to potentially experience growth and returns based on how a certain index or basket of securities performs. The structured products we will be focusing on now primarily are buffered exchange traded funds. They are also known as defined income ETFs. Now, we covered it on the previous slide, but for those of you not familiar with what ETFs are, they are pooled investments that operate similarly to mutual funds. They track a particular index, a sector, or commodity, but unlike mutual funds, they may be traded on an exchange throughout the trading day, the same way that individual stocks can be. So while we talked about investments within the structure of an annuity product, these buffered ETFs allow for more flexibility by trading in and out of them on any market day while maintaining the relative cost efficiency that exchange traded funds offer. Now, these ETFs will contain specific terms such as caps, downside buffers, and the length of the outcome period, which is similar to that point-to-point terminology used earlier. Now, to reiterate the objective here, the investor participates participates in the potential growth of an index up to that stated cap and is provided risk mitigation with that downside buffer. Now, the outcome period here is very important. If the outcome period for a particular buffered ETF is stated as being July of 2022 to July of 2023, as they're typically a year long, that doesn't mean one can't buy into it or sell out of it in the middle of the outcome period, because remember, you maintain the trading flexibility that a holding with intraday trading provides. So in the interest of simplicity, we'll say the investor bought the ETF at the beginning of the outcome period and held on to it through the end of the outcome period. We'll also assume there was a stated S&P 500 cap of 15% on the upside and a buffer of 10% for potential downside. So if you bought the ETF at the beginning of that outcome period at $25, you held it through the end of the outcome period, and the S&P was down 8% at the time, all that loss would have been given the buffer. Now, the ETF wouldn't exactly remain at $25 because funds have fees and expenses, could be in the neighborhood of 0.5% to 1% for these products, so you may be at $24.80. Another example with those same stated terms, you bought the ETF at the start of the outcome period at $25. The S&P was up 5%. Remember, your cap was up to 15%. So you realize that entire 5% S&P growth, minus the expenses, of course, so the ETF is now up, let's say, 4.2% during that time, factoring in that cost. Also keep in mind that the ETF doesn't automatically get liquidated at the end of the outcome period and goes away. It simply resets itself for another year, though likely with a new cap and or buffer. So very easy to maintain and monitor. Now, it's unlikely that your initial purchase will be exactly at the start of the outcome period. So let's say you buy the ETF 2 months late and you buy that July to July ETF in September. At that time, the fund happens to be down 5%. Now, this means that your remaining cap is actually now 20% because the fund first need 5% to get back to even, and then it has that 15% stated cap of growth for the entire period as well. So good opportunity there if you look into timing the market correctly. Now, if you were to buy that ETF when the fund was up 5%, well, then your remaining cap is just 10%, albeit for a shorter period of time. So there on your screen, you see different points throughout the year in which that particular ETF may have been bought. And the opportunities vary depending on how the market is performing. Now, this all goes back to Investing 101. You buy low, and the potential opportunity is greater than it would be if you bought high. Now, we always want to keep things in perspective. So while we do not pretend to know what lies ahead for the market, we tend to look back at history as a guide for trends and performance. So if we were to look back at the S&P 500 since 1957, which is a period of 65 years, we've had only 3 years that were down more than 20%, and only 10 years that were down more than 10%. 47 of those 65 years were positive, and 18 of those were negative. Something to think about when our minds go right to limiting downside capture. Now, these products, along with all of the products that are being discussed today, they're not for everybody. Buffered or defined outcome products are a potentially prudent way to manage risk when taking on stock market exposure. Remember that the larger the loss, the greater the gain required to get back to just that original level. However, if your plan involves a long time horizon, you may have the ability to weather the volatility of the market in either direction without capping yourself on that upside. And we simply don't know how the next generation of investors are going to feel about risk. If they've heard of or experienced tremendous periods of volatility and slow growth during their investment formative years, they may be more risk averse than previous generations, and investment in insurance companies will surely be there coming up with new products to cater to uneasy feelings on the market. Like Brent said earlier, however, there's no such thing as a free lunch, and surely sacrifices will need to be made on potential upside. And to cover the final area of our discussion, one which many of our clients inquire about or at least curious about, allow me to turn it over to Will Glenn. Will?
Thank you, Manny. This part of our webinar is very different from the earlier sections. We're going into a completely different area of modern investment concepts, digital currencies, often called cryptocurrencies. So what are digital currencies? A cryptocurrency is a digital or virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend. So what does that mean? Every cryptocurrency transaction is stored and verified by a global network of computers beyond the control of any person, company, or country. So who created the Bitcoin concept? Let's give you some background. A person or group using the name Satoshi Nakamoto published a white paper online explaining the principles behind a new kind of digital money called Bitcoin in late 2008. People actually tracked down a man named Satoshi Nakamoto, but the person they found denied creating the idea and has never been linked to the process. Digital currencies, as they exist, are not controlled by any single group, but numerous currencies have been created. One of the dangers of cryptocurrencies is that no one knows exactly who or what controls the value and blockchain of each currency. Since late 2008, numerous digital currencies have been created. In addition to Bitcoin, some of the better-known cryptocurrencies are Ethereum and Litecoin. There are many other cryptocurrencies out there, however, such as Solana, Cardano, and EOS, as well as many more. As we are changing to a completely new area of focus, we need to review some important disclosures regarding cryptocurrencies. Point number 1. Cryptocurrency is a digital representation of value that functions as a medium of exchange, a unit of account, or a store of value, but it does not have legal tender status. Cryptocurrencies are sometimes exchanged for US dollars or other currencies around the world, but they are not generally backed or supported by any government or central bank. Their value is completely derived by market forces of supply and demand, and they are more volatile than traditional currencies. Cryptocurrencies are not covered by either FDIC or SIPC insurance. Legislative and regulatory changes or actions at the state, federal, or international level may adversely affect the use, transfer, exchange, and value of cryptocurrency. Point number 2. Cryptocurrencies come with a number of risks, including volatile market price swings or flash crashes, market manipulation, and cybersecurity risks. In addition, cryptocurrency markets and exchanges are not regulated with the same controls or customer protections available in equity, option, futures, or foreign exchange investing. The database that holds all of the information is called the blockchain. Picture a chain you might use for a ship's anchor, but in this case, every link on the chain is a chunk of information that contains transaction data. At the top of the chain, you see what happened today, and as you move down the chain, you see older and older transactions. The open nature of data gives the blockchain powerful security advantages. It's an open, transparent record of a cryptocurrency's entire history. If anyone tries to manipulate a transaction, it will cause the link to break, and the entire network will see what happened. Bitcoins are created or mined via that huge decentralized network of computers, also known as peer-to-peer computer networks, which are also constantly verifying and securing the accuracy of the blockchain. In exchange for contributing their computing power to the blockchain, miners are rewarded with small amounts of cryptocurrency. The high energy consumption for mining activities has caused some governments and utilities to restrict mining of crypto. There are significant advantages of cryptocurrencies which have made them popular. These include cheaper and faster money transfers, no government control, such as no Federal Reserve monitoring the values or being able to restrict usage, and decentralized systems that do not collapse at a single point of failure. These can also be disadvantages, however. Cryptocurrencies have shown wild price volatility. They can be easy to lose, whether through losing the password or through theft or hacking. And because they are not controlled by governments and banks, they are often used in criminal activities. Now, should you be thinking of doing something illegal and getting paid off in cryptocurrency, realize that just because they are not controlled by the government doesn't mean they are not traceable. In February of this year, 2022, the Department of Justice was able to seize over $3.6 billion of stolen Bitcoin. According to Barron's Magazine, The Bitcoin that was stolen during the 2016 hack of Bitfinex, a virtual currency exchange, was valued at approximately $4.5 billion. This highlights what we consider to be the major risk of cryptocurrencies. There are governments and hackers devoting their substantial energies towards hacking these cryptocurrency systems. If, dare we say when, they do, owners of that cryptocurrency will simply lose their wealth, with little recourse to get it back. Any investor looking to invest in cryptocurrency should be prepared to lose all of their investment, not necessarily due to any of their own actions or actions of the market. With that said, if at some point in the future crypto reaches a point where it becomes a mainstream part of a diversified portfolio, we would likely see investment companies step in and issue mutual funds or ETFs that hold various cryptocurrencies. These companies could then be taking the burden of subjecting themselves to potential hackers and lost passwords away from the investor and placing it on themselves. Now, this wouldn't solve the issue of crypto's speculative nature and unprecedented volatility, but it could at least take away the fear of being victim at the hands of an unscrupulous group or individuals. We are still very cautious with investing in this area. For this discussion, we have pulled out several recent articles from the Wall Street Journal with additional details on some recent hackings on cryptocurrencies. We'll be happy to share these with you. Just let us know and we will provide PDF copies for your reading pleasure. Let's move to a different but related area. NFTs, or non-fungible tokens, are all over the news these days. To understand non-fungible tokens, let's first break down what the name means. Fungible means something that can be easily replaced with a similar item. Let's say water. Doesn't matter where you get the water, water is water. Same with gasoline. Doesn't matter if your gasoline came from Texas or Saudi Arabia, it is the same stuff. You can't tell where the gas you are putting in your car came from. Similarly, copy your paper. There are many brands and they are all interchangeable. Non-fungible means that the item is unique and not replaceable. It is a one-of-a-kind token unique for which someone is willing to pay money. A token means that it is a digital stand-in for the item. An NFT is a digital asset that represents real-world objects like art, music, in-game items, and videos. We are seeing artwork, trading cards, virtual worlds, collectibles, or representations. For example, cats. Each cat is unique, just like live cats. They are bought and sold online, frequently with cryptocurrency, and they are generally encoded with the same underlying software as many cryptos. NFTs are generally encoded with the same blockchain technology that we discussed earlier. NFTs have been around since 2014 and seem to be gaining popularity now because they are becoming an increasingly popular way to buy and sell digital artwork. We are seeing values of some of these items reportedly in the millions of dollars. We recommend keeping a sober perspective on these items. Our thinking on these is that the mania in this market is not unlike something that happened many years ago in the Netherlands. Tulip mania was a period during the Dutch Golden Age. Tulips were introduced to Holland around 1593 from the Middle East. In the early 1600s, more and more people began to understand tulips and the prices began to rise. Starting in 1634 and into 1636, the prices began to increase dramatically and then the market prices took off. By early 1637, contract prices for some bulbs of the recently induced and fashionable tulip reached extraordinarily high levels. According to Investopedia, at the height of the bubble, tulips sold for approximately 10,000 guilders, equal to the value of a mansion on the Amsterdam Grand Canal. Soon after, though, in February 1637, the prices on tulips began dramatically collapsing, and prices ended up low where they were before the mania. Look at the prices today. After about 400 years of inflation, your typical tulip goes for a whopping 30 or 40 cents per tulip bulb. That experience is what we refer to as mania. To finish the presentation, let me turn it back over to Chris.
Thank you, Will, and well done. We at the advisory group hold the belief that an educated client is our best client. We hope you learned a lot. and highly recommend that you attend our educational sessions throughout the year to keep up on the changes that are sure to happen. We covered a lot tonight. We discussed indexed annuities and the use of downside buffers and upside caps. Then we moved on to structured products, especially buffered or defined outcome ETFs. As we see increased volatility in the markets, we believe that some of the tools you have seen today can help reduce volatility of your investments while keeping the ability to gain some of the upside returns that we expect from the long-term equity markets. Then we looked at something that is dominating the news now, digital currencies, and looked at how they work, and equally important, the risks that they suffer. So what can you expect from us? The advisory group is here for you. As your financial professional, we are here to help you pursue your goals. One of our main focuses is to review potential changes for our clients on an ongoing basis. Prior to making any financial decisions, we highly recommend that you contact us so we can help determine the best strategy. There are often other factors to consider, including tax ramifications, increased risk, and time horizon fluctuations when changing anything in your financial plan. You can expect regular communication and have confidence that we are continuously reviewing economic, tax, estate, and investment issues for our clients. Many of our clients view us as their filter on all the many sources of data and information that are out there. We help our clients focus on what is important for them so they know what they need to know and yet can live their real lives. We will be offering other workshops that focus on tax changes and planning ideas throughout the remainder of this year. Here is our schedule through the end of the year. We have an investor update coming next month, July 27th. Seeing the rapid changes in the markets, we believe this webinar will provide market insight that you simply cannot get elsewhere. I want to highlight our next webinar on Social Security and long-term care, which is coming up in September. Everyone age 50 and over should attend this webinar. We will have additional webinars later this year. If you haven't already, please mark your calendars so you don't miss any of this important information. Most importantly, stay calm. In our opinion, the most important attribute of a successful long-term investor continues to be to stay calm and keep long-term perspective. The advisory group is here to help you stay calm and keep that long-term perspective. We want to thank you for listening to this webinar. We appreciate being able to help you with your financial needs. We wish you a very happy and healthy remainder of 2022. If you have any questions, please reach out to us and schedule a consultation. On the screen is our contact information. Once again, thank you for listening to this webinar.